Are you looking for a tax-efficient way to grow your wealth and passive income? The first thing you need to do, invest in property via an SPV. An SPV is essentially a limited company set up to hold and manage property. It's really simple to do. You can use any company's formation website, or you can get your accountant to set it up for you. Just set the company up using SIC codes 68100, 68209 and 68320. Now, the best advice that I can give you is don't set the company up immediately. Set it up once you've had an offer accepted on a property. That way you can get the rental income to pay for the accountancy fees. Now, this is the most important element of setting up the actual company structure. It's so important because the tax world and the finance world, they don't communicate very well together. So the advice that you get on the tax side might not correlate very well to the finance side. So the question is, well, how do you get this bit right? If you want access to 100% of lenders, set the company up with 2 directors and 2 shareholders. That will give you access to 100% of all the lenders operating within the SPV mortgage landscape. Now, if you have more than 2 directors, so 4 directors, 4 shareholders, then it will limit the amount of lenders that you can move forwards with to around 95%. So you're getting access to the majority of lenders out there, which is a good thing, because then you can get access to the cheapest money. If you go over 4 directors or have multiple shareholders, it starts to bring down that number quite considerably. And what we find is that interest rates and fees start to increase. So best advice I can give to you is if you're setting up your SPV and there's just 2 shareholders and 2 directors, you'll have access to the majority of lenders. If it's above that, you'll still have access to the majority of lenders. Cap it at 4. Anything above that is a little bit more bespoke. We'll have to work with bespoke lenders on that basis. Thinking about investing in property via an SPV? Book a free discovery call with me at my mortgage brokerage, SPV Mortgages. Just click on Let's Talk. Now, there are 2 ways of funding an SPV. You can do it either personally or via an intercompany loan. If you do it personally, it means that the monies are coming from a personal bank account. That could have come from a remortgage of a residential, remortgage of a personal buy-to-let, an investment account. But the monies essentially are sitting in a personal bank account, which is in your name. Those funds will be noted as a director's loan. From HMRC's standpoint, the money's already been taxed on the way in, so the money's not taxed on the way out. So a bit of a win there. If you're utilizing retained profits in a trading business, so in other words, you have a limited company in the background that has profits in it, you don't want to pay yourself a dividend in order to put the money into the limited company, your SPV, you can transfer those funds from the trading business bank account directly into the SPV bank account. Pros and cons. So you'll bypass dividend tax. That's a bit of a win. Cons, you will have a limited number of lenders that you can move forwards with. However, lots of lenders now have cottoned on to the fact that business owners are utilizing limited company or intercompany loans for their SPVs businesses. Now, that's good news because you'll get access to a number of different lenders within the SPV space. Even better news, and here's a bit of a pro tip, if you want access to 100% of lenders that are happy with intercompany loans, I'd recommend mirroring the ownership structures. For example, if the trading company is 100% in your name and you're the sole director, make sure the SPV is 100% in your name and you're also the sole director. If the ownerships don't mirror, we can still do the transaction. There are still lenders out there that are flexible with different ownership structures. It just reduces the number of lenders that we can move forwards with successfully. SPVs are taxed very differently to owning personal buy-to-lets. And here's the key difference. So an SPV is taxed the same way as a limited company. So you pay 19% corporation tax. But you can offset 100% of the mortgage interest. Can't do that in your personal name. And you can also offset 100% of the product fee as well. Can't do that in your personal name. So from a taxation standpoint, typically what you'll find, and obviously please seek tax advice. For high rate and additional rate taxpayers, most accountants say buy in a limited company structure as long as you don't need any of the residual income produced via the rental income to increase your standard of living. If you are looking to increase your standard of living, then most accountants say, look, just buy in your personal name, take the money, it's in your bank account, and avoid the accountancy fees. General rule of thumb though, high rate and additional rate taxpayers, buying through an SPV. Lower rate taxpayers, buying in their personal name. There are less limited company lenders than there are personal buy-to-let lenders. If you think of the big high street banks, the Halifaxes, the RBSs, the Santanders, the HSBCs, they all have a buy-to-let proposition. They don't have a limited company proposition at this time, but things are changing. So Metro Bank, they launched their limited company proposition only a few months ago, completely built a brand new system to cater for limited company applications. Leeds Building Society, top 3 building society in the lending space, also created a brand new system just for limited company lending. Both of those lenders currently have very, very attractive products. And what's happening is the competition now to grab a slice of the limited company market space is heating up. And I would say moving forwards, those big banks who have got their eyes on the limited company space will do something in the future. They're constrained right now because of their systems. Their systems are very archaic and they can't quite get their systems to work on a limited company basis, but things will change moving forwards. That would be my prediction. And that is super fantastic for competition. As competition increases and lenders want to grab a slice of the market, pricing will come down. I recently recorded a video all about SPV mortgages, what they are, how to apply for them, the pitfalls, the pros and cons. If you want to watch that video, click here. Please subscribe to the channel, and I will see you in the next video.